So, my name's Amy. Thank you very much for watching. Let's make some bad financial decisions together. Although I'm not sure Mike's ever made a bad financial decision ever. So,
I've made plenty.
this is for entertainment purposes only. So, if you're entertained, please like and subscribe. I would really appreciate that. Thank you so much for coming on here, Mike. I really appreciate that. So, would you please tell us what your role is at YieldMax and basically how it's evolved over time?
Sure. Oops, I should mute my phone, which I will do that now. I am the YieldMax ETF's strategist. What does the strategist do? So I do two things really. One of them is I serve essentially as a spokesperson for the funds, as somebody who has a background in options trading. So the idea is that I have some familiarity with options. And as people are trying to better understand what the underpinning strategies are, when they work best and maybe when, they don't work as well, why that would be. So that's certainly one part of my role. The other part of my role, which I'm not going to say this is an evolution. I don't know whether this was anticipated when they first reached out to me, but a couple of the strategies have had minor adjustments to their construction. The most notable of these since I arrived in the second half of last year was the change in how the constituents of Alti were selected. And, they added me to the Alti Investment Committee, the Salty Investment Committee. And so, I work with the CIO, the PMs, the traders, and some other PMs actually that are not named necessarily, but are involved with investment decision making, and contribute my thoughts and experience to that as well. So probably the best example of that is I have my own approach, I should say, to how I think about the way one should select a single stock portfolio. That is wholly separate actually from my background in options trading, because I also worked at a long short hedge fund many years ago, deep dive, sort of long holding period, private equity approach to investing. And so just, contributing what I think goes into a good security selection process, and, combining my experience and thoughts with, the experienced team that's already here. And I think some of that is reflected in the portfolio, but then there's also things that are selected that don't necessarily come from the process I would select, but are based on, the insights and experience and fundamental analysis of some of the other people on the team too.
So you're in Alti and Salty's investment committee. Are there any other funds within YieldMax that you're a part of the committee?
So not every fund necessarily needs to have an investment committee. And the reason is because what the investment committee would typically be doing is basically identifying those constituents that should be in the portfolio. In some other cases, that's either predefined or it's systematic. So you don't necessarily need an investment committee to do that. Let me give you some examples. So if, for example, you're looking at NVIDIA, which is the single stock options income ETF that is based on NVIDIA, well, you don't really need an investment committee to say, okay, are we going to have exposure to NVIDIA? Because that's actually predefined, right? And then there are portfolio ETFs where that's also going to be the case. So Biggie would be an example of this. Biggie is the one that tracks the top 50 largest by market cap stocks in the S&P. And that too is totally formulaic. Quad D, actually, which just launched last week, which I'm pretty excited about, that one is also formulaic. So there is no there's no investment decision-making process that identifies the constituents of the portfolio in those cases. In Alti's case, though, within the confines of the prospectus and within the confines of the remapped investment strategy, which includes both the screened, fundamental, and momentum-based core security selection, plus the non-correlated sleeve, plus what we call a special sit sleeve. So it's really that first group of stocks where I would have something to contribute. The special situations, I'm not out there going out and saying, oh, I'm going to pick a stock that I have a particularly strong view on for some reason that doesn't comply with my investment process, right? So I'm more on the process side for the principal group of securities, which is going to be based on momentum. It's going to be based on fundamentals, that sort of thing. And most of the YieldMax funds don't need an investment committee of that type to figure out what's going to be in there. So the traders are going to make the decisions on which options are selected based on the rule set that applies to the fund. So it's more on those areas where we have to identify what stocks are going to be in the fund that I would be involved.
Yeah, I actually do have a few questions about Quad D for you. So for those who don't know, it's literally just 4 Ds is the ticker symbol. So what percentage of the portfolio are we targeting to have under options? Because it's not the full portfolio, correct?
So the objective here is to achieve a certain yield from the options overlay. That's a fairly modest target, it should be said, because the objective for Quad D, and yes, you're right, the ticker is DDDD. We've been calling it Quad D internally because it just seems like it's easier to say. But yeah, the objective is to double the dividends that the SCHD portfolio or the Dow Jones 100 dividend payers would normally provide net of fees. So if the dividend yield at the moment is, we'll call it 3.5%, then the target yield for Quad D is going to be 7%. And now the underlying assets could be the individual stocks, or it could also be, at the moment, SCHD. Now, the reason SCHD is in there at the moment is because as the fund first starts off and before the assets really grow, there are some constituents in the fund that have relatively small weights, and it's easier to just sort of get the whole balance right by having the biggest constituents plus SCHD. My expectation would be that as the fund grows, you probably won't see SCHD in there quite as much and would probably, just see the underlying constituents. But the idea is to make sure that they are appropriately represented in the right weights and balances. So the objective is for the fund shares to track SCHD very, very closely.
Okay, so someone asked, what are we going to do about the reconstitution because it's happening this week? Like, my question would be, like, how long after the reconstitution would it take for your individual holdings to reflect that reconstitution in like a normal basis?
Yeah, I mean, we can make those adjustments essentially, in a day, right? So when the underlying fund gets rebalanced, and SCHD, for example, is based on, as I pointed out, the Dow Jones 100 dividend index stock. So we are going to rebalance this essentially on the same cadence, if you will.
Okay.
And in fact, that's also why we're going to be issuing the dividends only quarterly, because that is the cadence for SCHD's distributions. We therefore will know what our targets are and can track as closely as possible in this way. I'm going to just send that to voicemail. Got CNBC ringing me on the other line. Hopefully that wasn't too important. The objective here is to rebalance on the same cadence, to distribute on the same cadence. There is a slight delay, right? So the dividends for SCHD, because we're actually going to be passing those dividends along as well, right? So we own all the same underlying stocks. Those qualified dividends are going to get redistributed, and then you're going to have the options distributions on top of that.
Okay. So then that brings me to the next question because this is the first CoverHall ETF I've seen that actually pays you dividends as well as the premium. So how is that going to work with taxes? Like, if we own quadruple D for more than a year, will that be long-term capital gains, or?
So what would normally appear as qualified dividends will also be qualified dividends in this case. But the options income will likely be characterized as ordinary dividends or income in that case. So there's going to be, when I've gone over this in other contexts, when we've done things like explain how return of capital calculations work, number one, and then also how people can read that on their 1099 DIVs. But you're going to have box 1 and box 3 are the qualified portion and then the ordinary income portion. I don't know that there's going to be a lot in box 3, frankly, because the option income targets are so modest that I'm not anticipating any assignments really. And if they ever do happen, it's going to be really minimal. And that's one of the things that can end up causing, the return of capital. So the whole idea is that, return of capital, when that takes place, is really a function of timing, not just net asset value changes in the fund. So in this case, though, these things are going to be pretty far out of the money in most cases. So and the traders have been instructed to be very, judicious in their selection of strikes to, minimize the risk of any potential assignment. So I imagine that it's essentially the way I like to think about it, it's going to be like the SCHD fund with a kicker of additional income.
So we're expecting it to track pretty closely with the price of SCHD, because right now quadruple D and the price of SCHD are the same, right?
Yeah. Okay. Yeah, and actually that was also by design, just so that when people were looking at this, because we could have issued the shares at, an arbitrary price on the inception date, which is actually what you probably observe with most funds. It's not that common that a fund that has underpinning options on top of some underlying stocks, that they try to mirror the price. But in this case, it's helpful because it helps illustrate essentially what the whole idea is, and also so people can sort of track it pretty closely. So yeah, the objective is that the share price will have the price behavior of the underlying. And as we think about it, this should make sense because it's got the same underlying core holdings, just with a little bit of an options overlay supplementing it as well.
Okay. Yeah. So what I'm hearing is not a lot of return on capital with this, because we're not going to get assigned our options too often. It's going to be an interesting mix of qualified dividends and our regular income. And then I only noticed it because someone said something on X. So now in my HSA, I'm buying equal amounts of SCHD and quadruple D just so that I can personally track it. So I think it's interesting that we have a fund from YieldMax that, because like SCHD isn't all of like these real like growth funds that'll explode, hopefully. So
yeah,
hopefully we'll just kind of win all the bets and then get just 2 times the amount that you would expect from SCHD. So what, like, besides quadruple D, we have Big E, which is more for people that don't want to have to reinvest all the time. So do you think that quadruple D is a competitor to Big E, or like what kind of investor is quadruple D appropriate for?
I think the Quad D fund, well, first of all, there are a lot of people who buy dividend paying stocks because that's what they're looking for. I think of my mother, for example. She owns Kimberly-Clark. She's owned it forever. There was actually a period of time when if you were a Kimberly-Clark shareholder, they were giving you some kind of a discounted gift package. So every year we would get tons of toilet paper, Kleenex, whatever else from Kimberly-Clark every year around Christmas. But, there are people who invest. In fact, that was really the principal reason why people invested probably before World War II. I think it is, much more recent that people have invested in equities principally for capital appreciation rather than having a core pool of assets that were generating income that they could live off of. Now, the thing about stocks that pay high dividends is, as you pointed out, these tend to be more mature companies. They're not necessarily in sort of the growth phase any longer. And so, Big E, because by virtue of the fact that it's choosing the 50 largest market capitalization stocks, that's going to include things like NVIDIA. It's going to include things like Amazon. It's going to include a lot of the biggest companies that either don't pay a dividend, or if they do, it's fairly modest. Whereas SCHD, you're going to see more things like, a Verizon or AT&T in there. Some of these like Exxon and so on. These companies aren't really in that fast growth phase anymore. So the capital appreciation potential of the underlying portfolio is probably a little bit more modest. And of course, it's always going to be offset by the distributions. Anybody who's ever watched the stock and they said, how come the stock goes down after I get a dividend? It always has to trade down by that amount, because you can imagine if I've got $100 in my left hand, but I pay out $1, well, now I've got 99 over here and I've got one over here. I think this is an important thing to think about, which is that, Quad D is probably, a lower volatility basket of stocks in general, not growth stocks. So the investors that are going to be interested in having something like Biggie are really looking to have more of that growth element in there. The other thing I would say is that Quad D is intended to track the value of the underlying shares. Biggie is not tracking the value of, say, the S&P 500 or SPY, because it's paying out 1% a month. So it's essentially paying back some of those gains that you're making in terms of distributions each month. So it's a difference in terms of the constituent stocks, and it's a little bit of a difference in terms of philosophy also. I think there's frankly room for both, because I think some people are looking for some exposure, depending on their age too, of course. But, I think a lot of people who have exposure to equities, one of the things they like about having exposure to something like Biggie is that we don't know what the best performing stocks are going to be over the course of the next 5 years, or the next 10 or longer. But one of the things we know for sure is that Biggie will contain them, because the most successful stocks tend to become the biggest ones. And Biggie will have that, because it's going to have the top 10% of the largest companies in the S&P 500. Quad D is probably going to be a little bit more conservative in that sense, because that's really just looking at dividend payers, and dividend payers tend to, eliminate some of the highest growth stocks.
Yes, I was surprised when you all said that it was a quarterly player, because we were going, JEPI and JEPQ, they pay monthly. We've started going weekly, so, but it makes sense that if you are just trying to get double of the last distribution that happened, that you would keep it. And also, like, dividend payer stocks just don't pay as much. Like, you don't get as much with their call options, because you're already getting money from the dividend. I wanted to ask you about Feet and Fivey. How do you feel like they've been doing?
Feet and Fivey are kind of interesting animals, because it's not that they're outsourced, but they're using an allocation approach that is not ours, right? So Dorsey Wright is its own entity. They have their own technique and approach to security selection. And I don't happen to invest personally in any Dorsey Wright products. This is not a knock on Dorsey Wright in any way. It's just that hasn't typically been my approach. I actually think what I'll do here is, why don't we take a look at how they've been doing. Let's pull this up on my screen over here. So if I go back to the inception of Feet, that doesn't look like it's had a terrific go of it. That is, when you calculate back the distribution since inception, it looks like it's down about 18%. I don't know if that jives with your numbers, maybe a little bit more. Fivey is actually pretty much the same. At least according to the Bloomberg terminal. They did exceptionally well, it seems like, off of the off of that post-Liberation Day low. And I'm wondering if that's because Dorsey Wright's technical approach was able to capitalize on momentum during that period. I'm actually going to take a look at that.
Yeah.
So,
I think we've just spent so long in a market that's not being propelled by momentum, that when you have only 5 stocks and it's based off of past indicators with momentum, that they're just not winning. And
It is, yeah, I mean, it's interesting. So that there was a lot of sort of general market. I think you're right. We've had so many sort of idiosyncratic. Is that really the best way to think about it? We've had a lot of exogenous factors. The Liberation Day tariff announcement hit stocks very hard. There was some pivoting that took place thereafter, and equities rallied. And then more recently, we've had some geopolitical events, which probably don't need to rehash too much, but this is quite a shock when oil goes over $100 a barrel, for example, and that's going to end up having an impact. Yeah, so I'm taking a look. 5E, it was up almost 50% from post-Liberation Day up until the first week of October. And actually, this is kind of interesting because now that I think about it, and feet, not quite so much. Feet was up about 40 over that same period. So if we think back to what happened in early October, that was essentially when crypto really started to roll over. And I think that what had momentum from basically that post-Liberation Day low until early October, a lot of that risk on sort of higher beta stuff really sold off pretty hard. We saw that in the cryptocurrencies. We saw it in the treasury companies. We saw it in a lot of the other names in the space. But we also saw it just in high beta generally. It's a point actually I was making about some of the constituents that were in the Ulti fund going up until that week that didn't necessarily have that much to do with one another. Hims and Hers, generic pharmaceutical company, that's not necessarily a crypto business, but yet it traded fairly closely with it because there was, a real risk-off attitude that sort of took hold at that time. And it looks like it also impacted these. And my guess is that has something to do with any kind of a momentum methodology that's using that kind of a technical approach to identifying what you want to invest in, that if momentum suddenly turns against you, that it's probably hard for these things to keep up. Again, I'm not an expert on the Dorsey Wright methodology and why that would be the case. But just looking at it from the side and saying, okay, well, as I observe how these things behave, that does seem to be consistent.
Yeah, because the comment I had from this was like, why don't we just close them down? Because they're doing so poorly. But I mean, there's probably
I'm not 100% sure who that's up to. But yeah, I mean, and like I said, Dorsey Wright as an institution has been around for a long time. There's a lot of people who are apparently, quite satisfied with their approach. I don't think they would have been as successful as they have been for as long as they have been if that weren't true. They got acquired by NASDAQ. The people at NASDAQ, I know some of those people. They're thoughtful people, so I'm sure that they had a pretty good understanding of what's going on inside their business. Sometimes, though, when it comes to technical approaches to security selection, when you have securities that a relatively narrow universe, as you point out, then you are going to end up having a little bit more concentration risk. If you only choose 5 of them, that could potentially happen. So, yeah, we'll see how these perform in the years ahead if they last that long. But again, that's outside of my pay grade.
Okay. Yes, because I wanted to bring this into YieldMax because YieldMax is now doing momentum indicators to inform what constituents should be in it. So I was wondering, if we're not in a market that is being swayed by momentum, will that affect YieldMax?
So, the interesting thing about YieldMax is that, and again, since I'm not intimately familiar with Dorsey Wright's technical methodologies, I can't really speak to that. But what I can speak to is that one of the things that I rather like about the change in the weighting essentially that is being used in YieldMax is that it does allow winners to run a little bit longer. So there is a period of time, we'll call it a 3-week window over which this is being gauged. But effectively, if something has positive momentum, its weight as a constituent inside of the fund will be permitted to grow. And in general, that is a trading and investment philosophy that I like and generally adhere to. That is that if you have something that's working, let it continue to work. And it's one of the reasons why when you take a look at cap-weighted indices, so that's going to be the Russell, the NASDAQ 100, the S&P, that in general, they will often outperform their equal weight, relative. So if you look at the equal weight S&P 500, has it ever outperformed the S&P 500? It has, but, for most of the last several years, it hasn't kept pace with it. And one of the reasons is because you can imagine if every single time NVIDIA outperformed, you said, well, I'm going to sell more NVIDIA and buy more, we'll call it Fluor or something else that's in the index that hasn't been performing as well. Well, that has a certain logic, but it would have caused a meaningful drag on performance. So from an investment philosophy, risk management, trading strategy, I rather like the idea that you wouldn't rebalance it back to equal weight all the time for that reason. And you can imagine, if you're looking at the entire universe of YieldMax funds, there have been underpinning stocks that have options income strategies that did well. NVIDIA is obviously the best example of this, but there have been some that didn't do so well. Moderna would probably be the most notable example there. So if we had spent the last couple of years, every single time NVIDIA rallied, buying more Moderna. Now, Moderna has actually bounced this year. It's had a meaningful bounce back. But I think most people would agree that probably wouldn't have been a happy circumstance if they owned those stocks in their portfolio. And every single time NVIDIA had a gain, they sold off the gain so they could buy more Moderna. And Moderna ended up from the pandemic peak, to its recent lows last year. I think the decline was like 95%. So buying more and more of it probably would have been a painful exercise.
Even when Moderna is doing well, we'd still like to drag it through the mud.
Well, I'm not trying to drag it through the mud. I mean, I guess I'm just making an observation about trading using examples of underlying stocks where we happen to have funds, and just talking about what the potential implications of allowing your winners to run and not allocating more to things that are underperforming, versus selling off wins as soon as you get them so that you can add to stocks that have declined. Now, it's interesting. One of the reasons I think that there is a natural tendency for investors to do this is because of the old buy low, sell high mentality. And that is this idea that stocks, bounce up and down, and because they do that, they will be cheap at some point and expensive at others. And if that's one's philosophy, then you can sort of see how a rebalancing to equal weight portfolio might work, or how it might make sense to such a person. But the problem is that in the real world, the best performing companies end up getting on these sort of growth trajectories where you see, strong year after year growth. Such would certainly be the case for NVIDIA. It's been the case consistently for companies like Microsoft. And the issue is that, the price can go up, but that doesn't necessarily mean that the stock hasn't gotten cheaper. In NVIDIA's case, it actually did get cheaper over the years. If you looked at it relative to its forward earnings estimates, at one point, I think it was 40, 50 times forward. And, now, actually, I'll take a look. It's probably trading 20 times forward earnings right now. Yeah. Just because the growth, it has such a powerful effect. And so the anticipated earnings, their fiscal year ends in January. Let's just call it we'll call it $10 a share. But for the fiscal year ended January 2028, or even January 2027, we're looking at somewhere around 8.5 to $10.50 a share in that neighborhood. So it's trading about 20 times forward earnings. It's cheaper than the S&P is on that metric anyway.
Speaking of this just reminded me. You stated last year that you wanted to create an investment portfolio, like an income portfolio. Have you actually started that yet? The last time we talked to you, were still doing your analytics.
Yeah. So, and actually, it's interesting that you mentioned that, because now that Quad D has shown up, I've actually been trying to devise this one for my retired parents, such that, and that's one of the reasons why I'm pretty excited about the Quad D launch, because it's an easy one to explain to them, because they already own a lot of these stocks anyway, so that they could get the dividends. So the question then would be, do you want to own those same stocks, but possibly get, more than you are currently getting from the dividends? The way we model this, you should still have, the performance of the underlying stocks. So there's almost no reason not to. So I think I'm probably going to start with their portfolio even before I go to my own. Because theirs also probably deserves it, and also because they still have allocations to bonds, and I'm not, bond performance over the long run has not been great. And if you are concerned about inflation creeping in, things like that, and you can get a bond-like return from, a secure group of dividend-paying equities, I'd kind of rather do it that way.
Okay. Yeah, I was just curious because there's, in the YouTube world, accusations of slop and do you eat your own cooking have come back up. And so I do.
That's a very good point, actually, because, and you eat your own cooking is an expression that I have frequently used. And the SAIs are getting updated, and we realized that some of the SAIs did not reflect the portfolio ownership. So I think all of them are updated by now. I'm not 100% sure, but I think most of them were updated in February and the beginning of this month. And so they should reflect the ownership for the portfolio managers. So in the filings, that's going to be, whoever the fund, the named manager is. I will actually take a look at, say, NVIDIA, for example, so I can just see who the named manager of it is on the filing. It looks like
Jay, right? No.
Yeah, Jay owns, for what it's worth, Scott Snyder and Jay Petrocelli, and I believe both of them are named now in the SAI. Jay owns every single YieldMax fund. And when this question came up, and I saw on the SAI that wasn't the case, he actually sent me his account statement, or at least his account statement from one of his accounts. I'm sure he has many. But in at least the one account that he sent to me, and the statement was extremely long, as you would expect. It was like 53 pages, and there was a lot of stuff blacked out because, obviously he has family information in there, including his wife's information. But he has holdings in every single YieldMax fund, and Scott Snyder has holdings in the funds that he is managing. And Mike Venuto, who's the CIO, he's not named as the fund manager, but he disseminates what he's invested in independently over Blossom, so people can check that there. And, I've heard some people say, oh, well, the minute that, one of these things changes, you should have it at filing. Well, Title manages, I don't know, close to 300 funds overall, and YieldMax has close to 70. The SAIs are updated twice a year, and I'm not exactly sure what people who are making these suggestions are saying, how much more often that kind of stuff needs to happen. So we are not going to employ people whose only job it is to, update these things for an adjustment because somebody came in and bought some of these shares. But the ownership should be reflected. And yeah, these guys are eating their own cooking. Sometimes that, they're happy about that. And other times, like every other investor, we wish that the underlying had done better. I bought Misty. I ended up pivoting to Alti. I think I had brought that up. And I'm not one of the named fund managers, so my name's not going to appear on the SAIs the way Scott's or Jay's will. But Yeah, I mean, I was bullish on crypto in 24, and I continued to be into 25, and that worked up until July. After that, it didn't work so well.
Yeah, we all lost money. But I mean, it's the winter, and it doesn't mean it won't come back. It just means that for now we lost
It's
money.
bounced a little. It has bounced
So
back a little bit
yeah,
off the lows anyway.
yeah,
And there's not a lot of using Bitcoin as an example. There's not a lot of Bitcoin left to be mined. And, if you believe in cryptocurrency in the long run, then, I don't see why this wouldn't be a more compelling place to own it. But I also think people need to appreciate this is an asset that has had some really significant pullbacks in its history. In fact, this most recent pullback isn't anywhere near as severe as several of the other large ones that have taken place. I mean, there's at least 4 others where it fell back 80% peak to trough. Now, we all say when we buy something that, yeah, I'm willing to accept that kind of roller coaster. Oftentimes when the roller coaster comes, not everybody actually does have the stomach for it, it turns out. And they start puking it out. So
it's in my experience, it's been just over allocation, over leveraging that gets me. It's not that I'm okay with the volatility. It just needed to be less of an amount in my portfolio. So, one
do
more.
you use a risk? I'm curious what you use for, I mean, a lot of portfolio managers will kind of think about things on a risk basis. So the more volatile constituents of a fund will often have smaller allocations than the more volatile constituents will. I'm curious whether, in the management of your own affairs, whether you weight what you invest in based on the volatility of them. So, Biggie, not volatile. Something like Misty, quite volatile. So do you kind of equal weight that, or do you say, okay, I think Misty's going to be 2 to 3x as volatile as Biggie or some other assets that you have, and therefore I'm going to have a small amount in that and a larger amount in the things that I think are going to be more stable? I'm curious.
Yeah, I mean, I've evolved over time. I've gone from having half in gold, half in YieldMax, to having 30% of my portfolio in Ulti, which didn't end well for me, to now I'm 50% of my portfolio is in broad market indexes like the NASDAQ and the S&P 500. But for specifically, like, I have IBIT in winter. And so I'm trying to keep 20% of the amount that I have in IBIT in winter. That way I'm still long on my position in Bitcoin. But since I have so much margin out that, like, I just need in my margin account for it not to go completely wild. But if I believe in it, I'll overweight it in my portfolio. Like, I just turned 40, so I'm okay with having a larger allocation to Bitcoin because I happen to believe in crypto. So hopefully it'll work out for me in the next few years. But I would rather keep my inverses to like 20%. That way my portfolio isn't completely wiped out and I can like cling to that in the bad times. But I would rather just, buy the dip and keep my long position long. So I'm trying to get better at, like, okay, SLV shouldn't be more than 5% of my portfolio, things like that. So, it's just, do I believe in it? Is it appropriate for my portfolio right now? And that's just how I get into it.
On that latter front, just another thought, and this you'll see this in many aspects. So, for example, if you ever look at silver futures or oil futures, one of the things you'll notice is that the initial margin requirement for the futures goes up when the underlying asset becomes much more volatile. Managers who take, for example, a risk parity approach will allocate to individual assets inside their portfolio and raise those weightings if the volatility tends to come in, and decrease them as it tends to go up. The idea being that if an asset has suddenly started moving around very violently, they may not want to hold as much of it as they previously did when it was not behaving that way. And the interesting thing about that is that if we, let's just use it as a kind of a thought exercise. If one had done that at the tail end of last year and the beginning of this year, we can kind of consider what would have happened when silver, and it deserved to, by the way, when silver started to catch up and then really take off. When I say catch up, I'm thinking to gold. When it really started to take off late last year, its volatility increased quite significantly. And if you held it in a portfolio, let's say it was 5% of your portfolio at the beginning of 2025, by the end of 2025, it would certainly have to have been more than 5% unless the rest of your portfolio just absolutely crushed it because silver was up so much. But on top of that, so you probably would have been overweight by that point. But even if you weren't overweight simply because of its relative outperformance, assuming you had looked for like a 5 to 7% allocation, its volatility increased significantly. In fact, I'm actually going to take a look at how much it did. So I'm going to compare this and the price change in silver. And this, I think, will kind of speak to how some people approach that problem, which I think is, so I'm just going to go here. I'll see what the volatility was. I'm actually ignore the options premium. So at the beginning of year, we'll look at SLV, trades like a stock, right? So SLV started the year at 26.33. And by the end of the year, it was over 50. And 30-day volatility for SLV at the beginning of the year was 32. And by the end of the year, it was 55. So even if if you assume that 5% was a good allocation when it was a 32 volatility instrument, and you didn't want to take more risk in it by the end of the year, you probably would have cut your position by about 40% anyway. And on top of that, because it was already, by this point, it had well more than doubled, you actually would have taken all of your initial investment in silver off by the end of the year if you had taken this kind of an approach. So one where you were looking at a target weight, and two where you were looking at some form of risk parity, meaning that I don't want my portfolio to be completely driven by silver, which if you'd allocated 5%, the S&P was up, 18? So assume that you only had silver and the S&P, then 5% of your portfolio would have, by the end of the year, even before it, so by late December, it would have become, like 15% of your portfolio by then.
It's like, well, now it's time to rebalance.
So
yeah.
Yeah, and there would have been a lot of times along the way when you probably would have rebalanced. I mean, October, you certainly would have rebalanced it by October because by that time, vol had already started to move up significantly, and silver was up by mid-October. It was almost 50. SLV, I mean, not actually the silver futures, but yeah.
So YieldMax just came out with Miney as well, and I happen to like it because it's a combination of a lot of different types of metals, not just gold, not just silver. Would you mind talking a little bit about Miney and who it's appropriate for?
Yeah, I mean, so Miney, when people think about the miners, or when you hear them being discussed most often, for example, on CNBC or Bloomberg or Fox or whatever, people are usually referring to the precious metal miners. So you're thinking about the Anglo Gold Ashantis, the Newmonts, Barracks, things like this. Miney has exposure to industrial metals and to rare earth as well. So, I mean, I think this is a really important area. So I kind of feel that everybody should probably have some exposure to it. Since Miney launched, in terms of timing, I'm actually going to put GDX in here, which is the gold miners.
Yeah, I've been
just for my
surprised since the global incidents that just happened that gold has not done better, but I think from what I have observed, it's like people are taking money out of gold to buy oil or putting it into cash. Like I was just I've been surprised at how gold has acted during this crisis.
I think gold had a pretty good run. So there's really two things to think about: the implications on gold and the implications on the miners. So one of the things precious metal miners, for example, one of the reasons that the precious metal miners had performed so well was because if we think about it, they benefit obviously from the higher price for the commodity that they sell, and they also benefit from stable or even lower operational costs, input costs. So mining is energy intensive. Energy is an input cost for the miners. If oil goes from $55 a barrel, which is where West Texas Intermediate traded on its lows in mid-December, to 120, which is where it got to not this Sunday, but overnight last week. It got to a 119.46 for WTI. I know that most people use Brent as a benchmark. I still tend to use WTI because I used to trade on the NYMEX, so that's kind of like my benchmark oil, but they trade close enough to one another. So that would be, I think, one potential reason that you wouldn't see that. But, if you look at mining, GDX since February 27th, which is when mining launched, GDX is down almost 19% in total return. So that's just the gold miners ETF. And SILJ, which is the junior silver miners, is down almost 22%. And mining, because it's diversified by having exposure to rare earth and industrial metals, has total returns of down 10. So it's, about half of the downside. And you still have, it's a more diversified way to play metals and mining, I think, than some of the precious metals would be. And something else that has occurred to me, and that is that one of the things that geopolitical events keep reminding us of is the hazard that we have with excess dependence on the Gulf for energy. And if the sabotage of the Nord Stream pipeline didn't remind Europe of that, this is another reminder. And so it leads me to believe that there's going to be an increased interest in, energy diversification, just as a strategic imperative, right? Excess dependence on LNG from the Gulf, just as much as excess dependence on gas from Russia for Europe, is a strategic risk. And I suspect that, people who recognize that are probably going to start looking more at things like uranium plays and other areas to at least get some energy independence. At least it seems obvious to me. I don't know. I mean, it's that once again we're talking about things that are outside my pay grade. I don't get to determine the strategy of nations, but it seems obvious.
Yeah. So now that we're also talking, I just would like to point out to everybody that mine is in the same family of YieldMax ETFs like Chippy. So I believe, at least from my own observations, that because mine can be in a lot of different type of companies, that we'll actually see more price appreciation over time. And it's not going to be as high of a yield as some of these single stock ETFs, but over time, I think as long as people still value rare metals, this should be doing pretty okay over the
or uranium, as we were just talking about it. When I was talking about alternative energies, among the things I was thinking of was nuclear. I mean, mining contains Cameco. It contains Uranium Energy Corp. So it's got NuScale Power in it. NuScale Power is the small modular reactor company. So when you look at mining, gold, silver, those things play into it. Caterpillar is in there because Caterpillar is one of the largest heavy equipment manufacturers that plays in the mining space in particular. And of course it has, Southern Copper. It's got, silver and gold exposure as well. But I think that it's more diversified than just gold and silver for some of the reasons I articulated. I'll allow other people to make their own judgments and determinations about whether they think there's a bigger role for nuclear power in the future. But if you do believe that, there is exposure to that space in here, as well as the rare earths and things like that.
Yeah. So one criticism I've heard about YieldMax is that you see a trend and then you put in the prospectus and then it has to wait 75 days and then you can go, and then by the time something opens, the play is already almost over or halfway over. You're like in the middle of the momentum. Is there any plans for YieldMax to try to anticipate like what are some up and coming,
what will be hot,
like what will be hot, and just put prospectuses out for everything, and that way when it starts to get momentum, you can get it earlier in the cycle?
I think I would actually frame it a little bit differently, which is, YieldMax itself is a relatively new entity, and it was a prolific issuer for some time. We have a big assortment of arguably the most popular single stock options. So, people would often ask me, how did these things get selected? And I would say the market largely selected them. If you take a look at the single stock options income ETFs, and then you map that against the single stocks with the highest options volumes, you're going to see a lot of crossover. And at this point, we have exposure to the large cap, the 50 largest cap companies. We have exposure to semis and chips. We have exposure to metals and mining. We have exposure to dividend stocks. I think we're trying to get things out, with basically with the best possible pace. I think the way things are working, we're going to have a pretty good universe of coverage by the end of this year, I think, and only expect it to grow. But there is a limit to how many of these things you can issue at any given time. There's also the messaging issue. I think we have to get out and explain to everybody what each of these are. If we just simply said, okay, well, in an ideal world, if I could flip a switch and say, would I have exposure to each and every sector, and maybe each and every industry group inside of that sector, it would be nice to do that. Is it realistic? I don't think really. I mean, we're still in the education phase. It's still early days for options income funds and products relative to ETFs more broadly. We're probably the last 5 years have been when the lion's share of these things have been issued. So I think the pace has been reasonable. It is a little bit frustrating that one of the things that does end up happening is that if you are trying to issue a product where there is demand, where you see the volume and there's an opportunity, it's not up to us. The SEC has certain rules about what the timing of things are, and sometimes a lot can happen between the time that we want to get something out and when it actually does get out into the marketplace. But I also believe that a lot of these themes are not themes that only last for 75 days or 90 days. These are themes that are, I mean, we're talking about mining and we were talking about gold. How long has gold been important to humans from sort of an economic point of view? Thousands of years is the answer. So is it a little bit frustrating sometimes that when our product comes out, maybe it has just happened to have coincided with a period while we were waiting that things really took off? That can be frustrating, but I don't think that means that you missed the boat. We didn't miss the boat on gold and silver, because it's not as if that story is over as far as humans are concerned. It's got a lot more in it.
So if someone was interested in actually investing in the single stocks of YieldMax, what indicators should they use to judge when they should, get in and get out? Or what do people typically use, I guess we would say?
I don't know what people typically use for their stock selection process, but I do know what I use for mine. Okay. And for me, there's really, at a high level, just a couple of things that matter to me when it comes to picking stocks. So what are those? there are a couple fundamental factors. The fundamental factors are, I want to see companies where revenues are growing faster than revenues generally grow for the S&P 500. Why is that? Because the S&P 500, if you were going to just say set and forget and be an investor for the end of time, and Biggie probably within the YieldMax family of funds is probably a decent proxy for the S&P 500, that's always going to have the largest and most successful companies of its day. And by virtue of the fact that they're cap weighted, the underperforming stocks will fall out, naturally, and better performing stocks that we haven't seen or heard of before will find their way in. So if I'm going to go out and pick a stock to get long, I'm not really into selling stock short. I should just offer that as a bit of background for anybody who's thinking of, about how I think about the world. So if I'm going to pick a stock, I want it to be at least competitive with the S&P. The S&P is going to have the economy's winners, and it's well diversified. So if the S&P grows at 5-6% top line, 7 to 8% bottom line on a compound annual growth rate basis, then if I'm going to look for a stock that I want to add to my portfolio, I want it to be competitive with those kinds of numbers. So that's sort of a general sense of one sort of screening criteria people can consider when they're picking stocks for their own book. I also do care about momentum. It's been demonstrated to work. It's a factor that matters. So, when I'm looking to add to a position, typically I want it to be, above moving averages, 50, 100, 200. People have different preferences about the ones that they use. In general, I'm going to be looking at longer term moving averages. So it might be a 150-day moving average. I want it to be above that. If it falls below it, does that mean I automatically sell it? Not necessarily, but its ranking certainly drops relative to names that are, showing some momentum. So that's another factor that I will tend to use. What is another? I can't have my eyes on every single thing that goes on in every single company. There are some companies I know pretty well because I have followed them for a long time. There are a lot of companies I don't follow as well, but there always are people who do. So I do pay attention to not just an analyst, but to all analysts that cover it. So if a company starts to see that the analyst community overall is reducing their forward earnings estimates, reducing their forward revenue estimates, that is usually a warning sign to me. It means that the story is degrading somewhere. So I care about those things too. So when you look at the universe of stocks that you could either get long, or in the handful of cases where we have short bets, those are the kinds of things that you want to pay attention to, which is does the company have some kind of a moat? Is it growing? Generally speaking, I'm looking for earnings to be growing faster than revenues. That's just an indication that there's either operational efficiencies or other things that are improving margins. And I will typically try to avoid stocks where, the sell side and all the people who cover it are beginning to say, you know what, we're not expecting revenues to be as good. So those kinds of disappointing forecasts will pull stocks out of my universe. So a combination of technicals, fundamentals, and insights from people who are examining these companies more closely than I do.
And it's not really related, but you just started doing a podcast, right? Or
for YieldMax. Yeah,
yeah.
we just started. We call it the Khouw Down. It's on Thursdays after the close, and it's an opportunity for anybody who's interested in learning more about these. We love having these conversations with people like yourself and the Wolf Spaces on X. One of the things that's allowing us to do, though, is that if people ask us questions ahead of time, which they can send those questions to the YieldMax ETF's X account, then we can assemble some collateral to help illustrate some of these concepts. Because I think a lot of times, conversations are very helpful, but it's really nice if you can show people things, because we're dealing with numbers, and there's usually only so many numbers that people can hear coming at them from left and right. Sometimes it's better to show as well as tell.
And after you're done with those, are you posting them on YouTube or in another area, or are they just...
They are not. They're live. and we don't keep them recorded, and the reason for that is actually is simply compliance, and that is that if someone's asking me a question live, as you are doing now, I can answer it to the best of my ability. But if we create some form of content and then we preserve it for posterity, there's a higher compliance burden that accompanies that, and it has to be vetted by the compliance department. They have to approve everything that gets said. So even if we wanted to keep the recordings around, we would still have to take it down, send it to a third party, and they would review it. And if there was anything that they didn't like, they're like, we don't like the way that was phrased, or we don't like the way that was said. They would then have to chop it up and edit it.
Yeah.
So I don't know that there won't be segments that get shared. But again, that's not up to me. And, I understand why it is. If you have something that's recorded content, you're in the investment business, of course, it has to run through compliance, and they may or may not let you do it. I guess that's the simple way to think about it.
Okay, yeah. 'Cause last week I showed up on Wednesday and I was like, let's go. Why are you not here? And then it was like, it's on Thursday. And I was like, and then on Thursday I just spaced off. So I'll try to come in the future. Just some days.
Well, I think on X, because these are done on X Live, I think the first one went out only on X. I think the second one went out on both X and YouTube.
Okay.
If you hit the notification bell, if you follow the YieldMax account on YouTube and you hit the notification bell, I think you get a notification. And if you are one of those people, I always or almost always have X running somewhere on my computer. And you've probably seen this if you follow anybody on X, that if someone you follow is doing something live, you get a little pop-up that says so-and-so is live right now, and you'll see a little thing scrolling by. So you get a notification that way, just in case you don't remember. Because I'm like you. I mean, I intend, there's so many things I plan to listen to, and then I get sideways distracted doing something else, and I can't do it. And I kind of fully appreciate the desire to have it recorded, because my favorite podcasts, I listen to those when I'm walking the dog at 1.25 speed.
Yeah.
Because that's the one point I know when everybody else in the house isn't going to be offended that I'm not paying attention to them. I can just walk the dog. She doesn't mind. She's like, go ahead and listen to whatever you want. So yeah, notification bell, I guess, is probably the best alert. And we are going to be doing it at 4:30. I think the first one we did at 4:15, and then we pushed it back just a little bit, just so that people had a little bit more time to wrap up their daily stuff before we got started.
So I just have a couple more questions about Quad D that I forgot to ask before. There's always going to be that one person that asks, and so I'm sorry I have to ask this, but because it's a quarterly pair and the options are not as active, is there a chance that we could see some lower fees to have it be more competitive with other ETFs that also pay around an 8% for distributions?
Well, I guess the proof is going to be in the pudding when we think about it's really Quad D versus SCHD, and the objective is to get at least double the distributions, and that's going to be net of fees. If fees end up being some form of a drag on performance, then presumably that's going to be looked at. But even though there's not as many expirations to contend with, it would seem, the objective here is still actually quite intensive for the traders. This was something that actually on the live stream last week, that Quinn Berry, who's one of the portfolio managers who's managing Quad D, was talking about, is that the objective here is to ensure, when and wherever possible, that there is no assignments being taken. And assignment risk actually rises for stocks that pay dividends, because that's one of the reasons why people exercise call options early, is to capture the dividend. So even though the underlying stocks tend to have lower volatility, and the option strategies might not necessarily be rolled as frequently for reasons of expiration, the tenor of the options that are chosen, they actually have to be managed as closely, if not more closely, in this case because assignment risk rises. I think that's one of the reasons why people buy a product like this rather than manage it themselves, because every one of the underlying stocks pays a dividend. Every single one of these underlying stocks have call options that are exercised early to capture dividends before the ex-dividend date whenever those stocks are higher. And the implications of that are going to be felt two ways. One, does the underpinning portfolio of stocks actually track the index that it is supposed to, which is the Dow Jones 100 dividend payers, or SCHD, if that's the one that you happen to be looking at. And the other is a tax implication, right? So, there's a material risk that comes from early assignment in those cases. If you buy a stock in January and you end up having an assignment in March ahead of a dividend, presumably, if you got an assignment, that unless somebody exercised their call option improperly, that would mean that the underlying asset has appreciated, and it is appreciated through the strike, which means that you have just created a short-term taxable event. We don't want that to happen. So it is true that there's less trading activity in one sense, unlike a weekly, but it is also true that there are other things that actually require more attention than they typically would for other reasons, right? So, and there's 100 stocks in there, right? So it's still non-trivial in terms of portfolio management. And hopefully the performance makes people look at this and they say, you know what? If I liked SCHD and here I'm getting SCHD plus double the distribution net of fees, then I think it has sort of demonstrated it's paying for itself.
So, because we're trying to mirror the price action of SCHD, was there a reason why YieldMax went for doing call spreads instead of put spreads to get your premium? Because in Quad D, or are you talking about in general? In Quad D.
Okay. So, well, if you're trading, let's say you're doing credit put spreads as a proxy for a long position, one of the things that you want in this particular instance is to be long the underlying stocks, not to sell those stocks, and to collect all of the dividends so that you have that qualified dividend at least as half of the distribution amount, right? So for purposes of tax efficiency, simplicity, and transparency, just owning those stocks, collecting the dividends, and paying qualified dividends on a regular basis is an important aspect. So I think that's certainly one part of it. And as far as call spreads are concerned, rather than just selling covered calls, for the same reason that's the strategy that gets employed in the single stock options income ETFs, the idea is that if there's ever a chance that an underlying stock has some idiosyncratic event, I'll suggest something that's very unlikely to happen, but it'll sort of illustrate the point. If Coke decided that they were going to buy Pepsi, for example, that's the kind of circumstance where an underlying stock could move very sharply. And we don't want to forego any or much, I should say, of the potential upside in a scenario like that, which is the reason that you deploy call spreads. It's really to capture those idiosyncratic events where a stock moves much more than its underlying volatility process would suggest in a short period of time. So, constructed the way it is, you have the benefits of, carrying long-term capital gains essentially indefinitely. You have the benefit of qualified dividends, at least to the extent that the distributions include the qualified dividends. And then the options income component is intended to avoid any circumstance where you have an idiosyncratic upside move and you don't capture at least most of that move, and still also get options income. So you have essentially all four of those factors that go into why you would construct the portfolio in this way.
Okay. And this double distribution family of funds, this is just the first one. Do you have any plans to expand this family within YieldMax with different things?
So I guess the way I can say it, because we can never really discuss that. We can't discuss anything that hasn't been publicly disclosed, right? So, but I will say this: that is that YieldMax is always looking to expand the number of products. One of the things I think people who are watching with any sort of scrutiny will probably observe is that if you think about ETFs that make distributions, and then you think about ETFs that are all about capital gains and don't make any distributions, the pattern more recently at YieldMax has been to make sure that we are serving investors who are interested in capital appreciation with more modest distribution needs or requirements, as well as those who are trying to maximize them in the short term. So this is arguably the most conservative, I guess, in terms of distributions. The target distributions from an options perspective of, call it 3.5%, maybe 4% net annually, is a pretty modest ask. And I think the objective is to make sure that we have basically a family of funds that serve the whole thing. And I expect to see more products like this, I guess. That would be the best way to describe it.
Okay.
I think there's a demand for it. And I think also it's important for people to sort of understand that, we don't have a specific philosophy about the way people should think about distributions. We recognize that investors have different needs, different wants, and we want to make sure that we're serving the whole bunch of them and not just pigeonhole ourselves into saying, okay, well, we're just going to have funds that distribute anything and everything they can possibly get each week. We recognize that there are people who are in dividend paying stocks for the dividends, and we think we can do a little bit better than that, so we probably should.
So I was just thinking, do you have a launch date for Y10? I think it's Y10, the YieldMax 100 Club. That was something in a prospectus that I read last year. I was excited for.
I would have to double check, and let me see. Maybe I can ask somebody here. So maybe somebody has an update for that on me.
Yeah, because I think it was like a 100 Club. Not to be too bullish in this conversation or anything. I was wondering with the 100 Club if we're going to manipulate Ulti so that 1 month out of the year we get 100% yield, so I can just stay in the 100 Club because it's a
well, first of all, I will say for anybody who's been paying attention in recent weeks that the distribution on a number of names has actually gone up. The reason for that, of course, is that options premiums have gone up, and they have gone up because volatility has increased. So it's a double-edged sword. I mean, I will say, we like the juicy distributions when we can get them. We like to see options premiums elevated because we're probably better positioned than most to take advantage of that when it happens. We like higher implied options premiums because if the underlying stocks are falling, chances are people who are engaged in options income harvesting strategies the way we are probably outperforming to the downside because those distributions on the options premiums are probably offsetting some of the declines. But I think it's also important to remember, and this is something that, when people are thinking, okay, what do we want to root for? We always want to root for the stocks we hold to go higher. So it's great in the sense that we can get maybe better risk-adjusted performance when vols are higher relative to the equity. But if we could just sort of script the future the way we want it to take place, what we really want is for these stocks to chug higher in general. And not just always be rooting for the highest options premium. Because if every stock we hold is going up, whether the options premium we collect is a lot or we collect is a little, we'll be making money. If you're long stocks and they're going down, selling options premium can mitigate a lot of that pain, and it can cause smaller drawdowns. But smaller drawdowns isn't making money. So I had a former boss who once said, you can't eat outperformance. Yeah. So it's nice if they outperform when markets get choppy. We like that, of course. but we'd much rather that the markets chug higher.
I think that's pretty much all I wanted to talk to you about today. Do you have any other things that we haven't covered yet?
Well, now that you touched on the live stream, I think that's actually a great one, because this is an opportunity for you and everybody who watches your channel to get an in-depth answer to a question. So submit your questions to the YieldMax ETF's X handle. But just make sure you do it ahead of time, because what we do is we'll review those questions, and then the first ones that come in are usually the first ones that get answered. If you've watched any of the last live streams, you'll know that we don't just cherry pick questions that we like. There are, tougher questions that we get, and we're happy to deal with those. If there's a fund or a single stock options income ETF, not every one of these stocks has done well, so not every one of the options income ETFs has done really well, but we like to get into it so that people can kind of understand what the relative performance means, how to think about it. And if you have questions like that, submit them early so that we can get that collateral together, and so that you're not getting pushed down into the queue, because, of course, we can only answer so many. But that's an important thing to think about. Obviously, Quad D, I think, is a really important development for YieldMax. And I think it's because it points out that we are going to have a family of funds that essentially suits everybody's objective, from those that are looking for the most aggressive distributions in the short term to those who are seeking a more conservative group of underlying stocks, who want qualified dividends and who don't have, really big and immediate distribution requirements. So I'm not sure conservative is the best way to describe it, but it probably is more conservative than a conventional equity portfolio would be, because dividend stocks typically are relatively conservative. So it's going to have that element. I think those are probably the biggest things that deserve a mention at the moment.
Good. All right. A couple of more questions now, but anyways, I've heard in the news recently that there's been sort of like a bank run on private equity companies. Do you think that this is going to affect the market in a bigger way? Or what was your reaction to that news?
Private equity or private credit?
Sorry, private credit. I wrote down private equity, but yes, the private, Blackstone, BlackRock, they've met their cues for how, no one can take more money out of those funds because they've hit the limit for this time period.
Redemption. Yeah, they have redemption caps, essentially. So, Blackstone is a private equity company, but most of the scrutiny recently has been on private credit funds. So just so that people understand the difference between these, publicly traded stocks, private equity is the private equivalent of that. Essentially, people invest into funds, which in turn make investments into private companies. You can also buy bonds, or you can buy private credit funds. Private credit funds essentially are lenders to businesses. So it's kind of, if private equity is like the private version of stock, then private credit is like the private version of bonds. It has been under a lot of scrutiny recently, and I think there's a couple of reasons for this. One of the reasons is that whenever you have an asset class open up to a new class of investors, there tend to be some growing pains when that happens. And I think that has happened here. And one of the underlying backstories here that is playing into this is that a lot of the lending that takes place in private credit, you're dealing with companies that sometimes can't secure lending from a bank. And that doesn't necessarily mean that lending to those companies is a really bad idea, but it does mean that there may be some risks there that investors may or may not be completely aware of. I'll give you an example. Banks like to loan to businesses that have assets. So if you are going to build a commercial building, for example, in where you live, or if you operate a farm and you need to build a new barn, or you have some other reason that you need to borrow money, the banks usually like to see that there's some hard asset that underpins that. Software and services companies often need capital too, but they often don't have assets in the same kind of way. If I have a software business and I borrow money and suddenly that business is not generating the revenues, it's not generating the free cash flow that I hoped it would, what do I, as a lender to that company, now have as collateral against my loan? And the answer is probably the recovery on that is going to be smaller. The other thing is that we had AI. And AI, if you've been paying attention to the publicly traded universe, you'll notice that a lot of software and services companies got hard hit because a lot of people said, oh, well, AI is going to eat this industry. Well, if it's going to eat the publicly traded industry, you'll notice that Microsoft grossly underperformed NVIDIA from July of 2025 up until mid-February of this year at least. Well, what does that mean for some small software company that was borrowing at 11 or 12% in the private credit market? I mean, they're no Microsoft. So I think we don't know how bad the story is, if it really is a bad story. But what we do know is that there isn't a huge available amount of liquidity to meet the demand for redemptions as people began to better understand these risks. Or perhaps to realize that maybe they didn't understand what they were invested in as well as they thought they did. And, I will often say that, when a new sort of asset class emerges, it tends to have some growing pains because, people get excited about the pitch. And there was I think a fairly compelling pitch in there. But every investment includes some form of risk. And sometimes, even if those risks are disclosed, people don't understand them as well as they might. And they certainly start to understand them a lot better when they realize that, hey, wait a minute, the prices of some of these things are going down, and I can't get my money out as easily as I am used to in the publicly traded markets. So I think, is it over? I don't know. My hope is that it doesn't worsen considerably, but I'm not invested in any private credit. And even if I was, I'm not 100% sure that I'd know exactly what I owned. There is one bit of good news, though. So there's a hedge fund called Saba. It's run by a guy named Boaz Weinstein. He, I know, started to take a look at some of the underpinning credit in some of these funds and offering liquidity and sort of becoming a strategic or a special situations investor. I'm assuming that others will too. That's a good sign. I do like to see opportunistic folks coming in on the buy side, but I don't know that enough have come in sufficient size to lend that market the liquidity it needs. It's never a good thing when you see that there was a redemption request for 15% of a fund's assets, and they said, oh, we're going to cap it. If you read the small print, it says that over a quarter we could never redeem more than 7 or whatever the number is. It does cause a little bit of anxiety. So for any of your viewers who happen to be involved with private credit, all the best. I wish I had more comfort to offer.
I think for the most part, I don't know my audience's specific situations, but there could be an instance where your 401k kind of, if you were in like a Target 25 fund, it might sneakily put in a certain amount of allocation to these type of things, because that recently got added as an option. So I guess check your retirement accounts and make sure that you're understanding everything that you're in. My last question for you, and I'm not sure if you even want to answer it, but your daughter, did she just start college, or she's starting college next year?
Sons. I have two sons.
Sorry.
Yeah. When I was talking about her, I was talking about our Great Pyrenees. That's Sophie. But yeah, so I have two sons. One of them is going to be going to college next year. And it's probably by the end of this week that we're going to figure out where he's going to school.
That's
because
so
he still has a couple to hear from. He had partial academic scholarship offers from 2 places. So it's a combination of what he wants to major in, whether he likes the lifestyle, where that is, and what kind of offers he's gotten from the respective schools.
So I was wondering, because we're talking about finances and everything with AI, we don't know even the jobscape is going to be like in 5 years. Are you thinking about setting your son up with some kind of an income portfolio so that he can manage his own budget with
it's really interesting. So it's interesting. So he has, well, first of all, in terms of his academic interests, he has expressed an interest in both business and finance and artificial intelligence. He did AP computer science for a couple of years, so he did get into an AI program at one of the universities he's applied to. And it is going to be highly disruptive to the business world for sure. And I actually think this is good news for investors. I'm not so sure it's great for people who work in the investment business, but it's good news for investors. I have brought this to his attention that he really ought to be giving some thought to, building his investment portfolio now, because whatever job he thought he was, best suited to, most interested in, I'm not 100% sure it's going to exist 10 years from now, or at least not in its current form. And actually, a lot of the things that I have done have already been largely displaced by technology. I started off as a floor-based options trader, open outcry, colorful jacket, yelling and screaming, waving pads of paper around. People don't do that anymore. The first floor I worked on, the Philadelphia Stock Exchange, they have a trading floor, but it's a much smaller one, and it's a very different one. Yeah. The New York Mercantile Exchange, where we used to trade the energy commodities, that has also closed. So technology displaced these things. I think for investors, that's good. But if you're a floor-based options trader, not so good. So, and to manage that stability, to be stable through that, you do need to probably save more, I think, at an earlier age than it was necessary to in prior generations, because it's quite possible, maybe even likely, that people's careers are going to change multiple times before they're done. My father was an orthodontist. That's all he ever was. From his, when he retired as an orthodontist. My mother was a school teacher, and that's all she did. But at this point, for people who are going into other areas of life, it's not so clear that they're going to be doing the same thing the whole time. And sometimes they're going to be empowered by artificial intelligence and robotics and other areas, but it would be unrealistic to assume that there aren't a number of people that will also be displaced by it. And, creating a cushion, creating an investment portfolio to weather those times is probably as important now as it ever was.
Thank you for answering that. I was really curious because, my nieces and nephews, they're not even high school yet. So hopefully by the time they go to college, we'll have a better idea about what the job landscape even is going to be. The market has uncertainty, but I wouldn't want to be sending someone off to college right now. So
I will say one thing, if I might, before we go about this, though, and that is that for the autodidacts amongst us, the people who want to educate themselves, it's never been better than it is right now. The same son who's going to college, he decided recently that he, wants to play guitar. And he's teaching himself largely with with what you have access to. That has been improving so significantly that I walk by his room and I'm dumbfounded by how much better he's getting and how quickly he is. And when there's something that he wants to learn about, he can just go ahead and do that. In this sense, I think this is probably the healthiest thing that can happen and that people should remember, which is that, when I went to college, where you went to school, for some jobs, tended to matter. If you went to, we'll call it a prestigious university, I'll put quotes around that, but that was, very important for some employers. I'm increasingly of the view that people's skills can transcend a little bit more, and I think that's actually a positive development. I don't really want a universe where somebody has to just have a connection because they went to the right school or know the right people. I think that the modern landscape is one where people can teach themselves and develop skills much more quickly than they ever could before. That's an important democratization that's taken place, and technology has afforded us that. And I think people that think, oh well, I got into Harvard or I got into Stanford and I can major in anything, come out, and probably I'll have a good connection, get me into a good job. I think that's maybe a little bit less important than it used to be. And for most people, I think that's a good thing. Maybe not for the person with the connections, maybe not for the person with that degree, but overall, I think that's a real positive.
Yeah, so it's either good nor bad. It's just going to be different, and we should all just stay invested. And, it's going to be good for businesses and people that are investing, and we can't say anything for anybody else. So, yeah,
That's right.
that's really that's all I wanted to say for today. So,
Yeah.
yeah, anything else from you or?
No, I just really appreciate your time and the thoughtful questions, and I look forward to our next conversation.
Yes.
And Thursday, 4:30, don't forget, that's when we're going to be doing the next live stream. And if you have any additional questions that we didn't get to today, put them in our X account, and we will try to answer them.
Yeah, and also Wednesday at noon we have the Wolf Space.
Yes.
So you're everywhere, then.
I guess so.
Anyways, I'll talk to you later.